Welcome everyone to this wonderful seminar that we're putting on. Thank you to Micro Technologies for sponsoring it. We're going to be chatting about farm loans today, how we're evaluating them. Some fantastic members of the industry up here. I'll be leading the conversation. My name is Millaine Wells. I'm the host of Midwest Farm Weekly. It's produced by a CBS station out of Green Bay, Wisconsin, but we air in several different markets across the Midwest. We cover a lot of different parts of production agriculture. We have a lot of dairy in the region where I'm from. I'm actually fortunate to live on a fifth generation dairy farm, so I get to learn a lot about the hands-on operation of a farm work, but this is a topic that I'm excited to learn a little bit more about as my husband and I take on a little bit more of the ownership and leadership roles around our farms. No doubt that will involve banking and lending through that process. We welcome Sam Miller, who is here from BMO Harris. He has over 37 years of experience in banking. He's on the board of directors for many organizations, and he is very well versed in this topic. Welcome to you. We also say hello to Roger Murray, who serves as the Executive Vice President and Chief Marketplace Officer for Farm Credit East. He serves customers in New York, New Jersey, and New England, also 40 years of lending experience. Finally, good morning to Matthew Wilson, who is the VP of Senior Relationship Manager for Rabo AgriFinance in Amarillo, Texas. He is also going to be speaking about a lot of these great topics, and we are going to have time at the end for you to ask your questions as well, so please feel free to think of those as we are going. I think we should kick things off, though, with a question that could probably fill the entire hour. What is the lending climate like right now for farmers?
So it's actually pretty good. If you look at the last couple of years, the farm economy has been pretty good, almost across the board. It is, and what that's done is it's helped strengthen balance sheets, improved working capital, cash flow and profitability have been good. There are some storm clouds on the horizon, though, and so that is altering the outlook on a number of issues because of higher input costs predominantly. Commodity prices have been holding up. Even milk prices, although they're up, they're not up as much as expenses are. So margin compression is happening. That's certainly a big impact, but that's the general sense of the lending climate right today.
I don't really have much else to add to that. It varies a lot by region, and some of the dairy processors are putting in production caps, and that really has changed the paradigm shift, I should say, for a lot of the producers in the East anyway. They've always been able to grow their way out of certain options or additional CapEx needs they might want to do, add a few cows and pay for the additional debt. But that isn't quite as easy now with the current climate. So I'll pass it over to Matt.
Well, I guess I'm the young pup of the group. I've only been doing this about 30 years. So, but I'll echo their comments. I've never seen the balance sheets look better overall in the farm sector, and a lot of reasons for that. Had some really good years in the last 10 that I think, particularly with dairy, has firmed up the balance sheets. But certainly the production limits and the supply situation is troubling right now. And I think we just got to hope demand continues to recover as the economy expands, and we'll find some additional places to go with all the milk we're producing.
Sam, you mentioned the storm clouds. This is sort of lack thereof when we talk about drought in many regions of the country right now. How have lending institutions worked with their customers to navigate a pretty uncertain harvest this year?
So it really depends on where you are as to how you're doing from a weather perspective. As we've been talking to clients, even as I got down here earlier today and saw a number of them, it depends where you're located as to how your season was. So there's a couple of ways. If you're in those tougher areas, obviously you're trying to build inventory as much as you can, but you're going to look for alternative feedstuffs. I think that's one reason we've seen the culling of the dairy herd start to increase in the last couple of months, is because hey, maybe we just don't have, that margin compression is happening, and it's showing up in higher feed costs. So what are we doing with them? It's really about what is their plan? What kind of budgets are you putting together? How are you going to try to mitigate the tighter margin situation?
Anything additional from either of you?
I'll just add, certainly the extensions that allow for additional cash flow flexibility to get through the next year. Most of our growers would have more than 12 months feed on hand, so this is the year they use some of that up. But there has been some business adjustments, such as reducing young stock growers, those young stock numbers, those kind of things, to be able to free up some resources.
I don't have anything to tack on to that.
I can actually start with you, though, on my next question. You mentioned balance sheets kind of getting firmed up a bit. What role did government stimulus play in all of that, and is it giving us a true picture? There's been billions of dollars influxed into this industry. I know a lot of farmers paid out some outstanding bills, outstanding debt. Speaking as a custom operator, it was great for us to get some of that cash and some of those bills paid down that people had been outstanding on, but do we have a true picture because of that?
You know, I think the government stimulus really depends on the size of the operations. A larger dairy is going to cap out on those payments pretty quick. So the impact of those payments is going to be diluted. But, for a smaller dairy operation, it's absolutely very impactful. And, I think as far as do we have a true picture of the farm finances, I think that always boils down to, how good a job is the borrower doing. One thing that we really stress at Rabobank is good financial reporting, usage of accounting. It's for preparation of balance sheets and things like that. So I think we have a pretty good picture, because I think overall in the industry we do a pretty good job in the dairy sector of getting good information.
The only thing I'd add is the quality of information is critical, and most of our growers have been able to look at what their cost of production and their net profitability per cow, for instance, without having that revenue put in from last year. And that really, it gives you a more true picture of the long-term cash flow viability.
So just one comment to add. Obviously, that money was real, and it showed up on the balance sheet. So that you got a really true picture of what's going on in the balance sheet. The question mark is the cash flow sustainable? And what we have done at BMO Harris is we've looked at what cash flow debt service coverage look like with the government payments and without them, just to try to get an idea of what that difference is and discuss what that issue is. Having said that, 2020 was a really wild year. I mean, we had almost record low milk prices followed by record high milk prices, almost. I mean, the gap, the difference from 1 month to the next in terms of what Class 3 did has never, ever been done before. So I wouldn't know if that, or wouldn't say that was exactly a normal circumstance either. So I think the true picture, you've got to look at what the end results were, but understand, as Roger and Matt said, what your cost of production is and what's been going on with it.
When we talk about inflation, that's also running at a higher level than in recent years. What impact do you see that having specifically on rates?
Yeah, I think it's really interesting. If you look at just in the last, I think the 10-year Treasury rate has increased every day for the last 6 days. That's not usually the case. It's still very low. I mean, the 10-year Treasury is trading about 1.5%. What that says is that's a pretty good proxy for what the market thinks inflation's going to be like 10 years down the road. So it is having an impact, but it's a pretty muted one, I would say, on rates at this point in time.
We're still seeing a large volume of our producers look at consolidating debt on the long term and getting as long a term fix as they could. With access to the full range of the yield curve, the 25-year loan fix can be a real plus for a lot of our customers, and that allows them to be more flexible on their short-term needs as well. So that's been a real push the last several years, and I think there's still opportunities. As Sam said, the market is that still well below historical trends.
As far as, how inflation impacts interest rates, I think we just have to watch and see what the Fed does. Will they continue to support, with purchases in the market? Overall, and I've had this conversation quite a bit with a lot of customers, but, everybody worries about rising interest rates. I think we'll almost have a 2 steps forward, 1 step back in the market with interest rates, because cheap money's priced into everything. I mean, it's priced into our inventory carries, cost of inputs, et cetera. So I think rapid increases in interest rates are going to stall things out pretty quickly, and I would anticipate a slow rise in interest rates, but it'll be interesting to watch for sure.
When farmers are looking at where to spend their money, is equipment still holding value? Do you look at that as a strong investment?
It appears to me that right now equipment would be a good investment simply because of availability of new stuff. Certainly used equipment we've noticed has been, the market's been strong for that.
Any additional?
The only thing I would comment on is a lot of our dairy consultants that are working with customers are looking at, as I mentioned before, a little bit of a paradigm shift. So it's more about getting the farm in sync. Buying a new chopper because you may have the cash flow to do that may put other things out of sync. In the past, you could have expanded possibly to cover, put some additional cows on to help pay for some of these things. And the equipment is usually not a bad investment with maintaining the technology you need. And the data that comes from this new equipment has really, really been helpful for a lot of customers. But it's all about staying in balance.
You're good. I guess same question when it relates to land. If land becomes available for a farmer, is that still the gold standard? Is land where you put your money?
It's interesting right now. I'll be curious what the other two panelists also have to say. There's been a lot of interest globally on investing in land, whether it's farmland, certainly dairy farming and or timber, all of those kind of things, and it's looked at as a risk potential, a risk mitigator potential for inflation. And it's interesting, the farm next door doesn't come up very often, but we really have to look at, are you going to churn those dollars that come from that additional investment? Or are you actually going to earn some additional profit? And that's the hard thing to do. It's very specific to each individual farmer.
So land historically has been a fantastic investment, and it typically can out-yield the stock market in the long run. Never in my career has land paid for itself when you buy it. So it's a combination of the earnings you get off it every season and long-term appreciation. That's where land makes sense. So as a short-term investment, not a good one. As a long-term investment, it still is and remains so. With interest rates low and commodity prices high, that's what's driving land values higher. And I would expect that trend to continue. I was visiting with a banker friend of mine from Iowa yesterday, and he was telling me about some land sales in his market. And he said, we had a farmer that paid a little over $16,000 an acre for some land, and a month later sold a 40 for $17,600. So you see some trading going on as well. And it's not just farmers doing all the buying, although I see farmers as being the dominant buyers of farmland. But there are some other equity, some other monies that are coming into purchasing farmland.
And I think what's driving a lot of that other money we're talking about here is low yields, low interest rates for CDs, et cetera. Your quote unquote safe investments. It's practically nothing now, so you've got a lot of money chasing yield, and I think that's what's driven a lot of money from these institutional funds that are active in our markets, that have driven them into farmland is simply chasing yield. We've over the last 20, 30 years had generally increasing crop prices and lowering of interest rates, and I think those two things have created the situation we have now. So I guess the troubling thing is if you have interest rates rising and we have commodity prices declining going forward, I certainly think it could be a drag on prices and values.
We found ourselves in a situation where we are doing a barn project right now because we had some unintentional skylights in our barn, if that makes sense. And by the time we took the roof off and the timbers were bad, and so now we're building a barn. But coming out of a time frame when plywood was as much as granite, it seemed like, were you telling people to wait? Are you still telling people to wait if they can?
Well, that's a tough call. I try not to advise a dairy producer or whoever.
I'm trying to settle a debate around our dinner table.
Yeah.
I'm kidding.
I think that's a really good question. It seems like things are kind of have plateaued cost-wise. We have some producers who are midstream with some expansions, and it's really impacted, cost overruns, et cetera, on those projects. So, but it seems to be slowing down. I hope maybe I'm just telling myself that to make myself feel better.
We also finance a large section of the forest products industry, so we've got to see some of the earnings that they were able to achieve over the last 12, 18 months as well. But I agree with Matt's comments. I think things have come back down to a little bit more the mean. But the other big piece is more, it's not if it is the right time, but making sure you have the resources available, the contingencies if you do have a cost overrun. And the other big part that we're seeing, and no matter what construction project, is the availability of certain pieces. So you could be all set, shells up, the roof's on, and you're still waiting on some critical, important piece that can't be shipped in for one reason or another, and you have to go 6 months more with all that asset sitting there empty, not generating any revenue. And so that's probably the biggest thing. It takes a lot more planning and more contracting to get it done, I think, efficiently.
Yeah, I don't really have much to add on that, other than what Roger really points out is the supply chain disruptions that are happening across every kind of business and every type of commodity. So, what was driving the higher building cost? Was it just that, was it the tariffs that we had on Canada? Was it just that lumber mills were not operating at full tilt? Was it that we had no demand and all of a sudden demand ramped up? The answer is yes. It's all the above. And then you add on top of that the inability to get products moved either across the ocean or across the country via truck or ship. And you're experiencing that everywhere. I toured one of our clients that built a new farm equipment dealership, and we walked in the lobby, and the cans of oil and parts are just laying on the floor, or he's got them actually stacked on pallets. And I said, "What's going on?" He said, "I can't get the racking. It's been back ordered for 9 months." So, it can be really simple things, or it can be something that's really complicated and critical to the enterprise.
In talking with you guys, it sounds like relationship building is a critical part of lending. Why is it important to form that relationship with the person that you're going to be asking for a loan?
We all have some gray hair up here, right? And we've been around the block a little bit. And through that 30 to 40-year career that we've had, there's been some really good times and some really rough ones. And so you want to build that relationship so that when you go through those difficult times, you know how each other are going to act and react. And that's a critical component of building that. Just look at the microcosm of the last 2 years. I mentioned we had the biggest change in milk prices from 1 month to the next. Were we panicking when milk prices had absolutely cratered? And were we euphoric when they absolutely exploded? And the answer is no, because we've been through cycles, you don't know and understand it, and the cure for high prices are high prices, and the cure for low prices are low prices. So it has a way of working itself around.
I'll just echo what Sam said. Obviously, relationships have been key in my career as well, and it's really been the best part of what we do as lenders is all the relationships we have with our customers. But it is probably more important that all aspects of the operation are included in communicating on those relationships. So if it's a husband and wife team, they both got to be at the table. You always include the vet, the nutritionist, those types of things. You have a profitability team, that's really going to make a big difference on how well that operation goes. The other part is, of course, building the awareness and understanding of that next generation that's going to be taking over that business as well.
Well, I think relationships are critical in every facet of every business, but particularly critical, I think, in a lender-client relationship. And I think it boils down to a relationship usually exists when there's good communication, and good communication is critical, whether it's good times or bad times. Whether it's you're looking for ideas on how to invest additional capital, or maybe in tougher times when you've got some really tough decisions to make. And so that good communication really comes into play when you're trying to find an outcome that's beneficial to everybody.
And piggybacking off of that, I can't speak to other states, but I know Wisconsin was coming off a few years of absolute records when it came to farm bankruptcies. I know I didn't want to go to mom and dad when my allowance money ran out, but you don't want to get to that point, correct? You want to bring up those concerns before we're in crisis.
Yeah, I think anybody that says that asking for forgiveness is better than getting permission in the banking world, that's certainly not the case. So, I have a lot more success going to a credit committee and explaining a situation that we're anticipating and finding a solution, hopefully ahead of time, than reacting. Again, going back to communication, did we know it was coming? Were we able to plan for that or not?
I don't have anything else.
Let's talk a bit about the looking forward, the highlights that you see in this industry, the things you're excited about, the things that are lending a bright spot in what you're doing right now compared to some of the darker times that you have alluded to.
I think certainly in the dairy sector in particular, I look back at 2014 and just say, thank you. That was a big shot in the arm. A lot of dairy producers in our area had expanded, had relocated to Texas, New Mexico from other parts of the country in the early 2000s, and then 2009 came along, and that was a tough time, and it was a tough climb out of what that did to balance sheets, and so 2014 was a really nice shot in the arm. Just 1 year really allowed a lot of operations to jump forward. But so I guess I'm thankful for the balance sheets, the liquidity, the staying power that we've created in the last 10 years. That's allowing us to, I think, have a better shot at weathering the storm we're kind of headed into right now.
Over my 40 years, I've been through prime being 19%. The whole herd buyout program way back when, as well as many other issues over the years. And so clearly I couldn't agree more with what Matt said. A lot of our dairy customers are in the best possible position to weather any adversity that comes at them. Sure, there's going to be some people that just are in the middle of an expansion or the neighbor's farm purchase that is going to add some more risk, but most are in really good shape, and we look forward to working with them to get through the next cycle. It's more critical now than ever, I think, to maintain discipline and try and be patient. Cash in the checkbook. Last year, good year, maybe it makes sense to do something, or maybe it makes sense to wait for another year or two and take advantage of a really good opportunity that comes at. It's not just so much what's current in your business, but also being able to seize the next opportunity, whether it's that neighbor's farm that came in at a much better price than you would have thought, or some other opportunity of an investment.
I think what makes me excited is the number of tools that are available to dairy producers today. On just the risk management side, dairy margin coverage, dairy revenue protection, LGM dairy, futures, contracts, options. So there's ways to help manage and mitigate risk. Secondly, it's the tools that the industry has brought. I mean, it wasn't that long ago that genomic testing came in, that sex semen use came into play. How that has transformed dairy businesses is nothing short of spectacular. There are other automation and investments that are coming on down the road. I think dairy, with the conversation about carbon neutrality and the ability for operations to financially benefit, I think dairy is going to have a good spot at the table there. Large dairies are looking at renewable natural gas projects. Other dairy operations are looking at the use of cover crops, and can they harvest some additional revenue out of that particular process. So you may not be able to expand the herd, but there may be other revenue sources that are out there, and I think that provides some optimism for this sector as well.
When it comes to size of dairies, does size matter when it comes to lending?
It's pretty clear that in dairy that there are economies of size and scale. We can debate about where that number is, but there are definite economies of size and scale that come into play in the dairy side. So then you have to look at what are some of the mitigants there. And I think that's where the Dairy Margin Coverage Program has really helped smaller producers by providing that greater safety net.
Yeah, I'd echo that. Also, the other smaller farms have the ability to adapt maybe pretty well, whether it's non-farm income, diverse enterprises, if you're near a local urban market that you could leverage your other land for vegetable sales, different things of that nature. There's just a lot of different opportunities that the dairy farms can work with, as well as some of the bigger ones. So size does matter, but I would argue some of our most profitable farms are still small and medium-sized farms that have figured out the right formula and got everything in balance.
I think there are pros and cons either way you go. A smaller dairy may not have all the economies of scale and size, but at the same time, they're probably not exposed to the disruptions in the labor market that we're having in some of the larger operations now. So I think it all depends on how how the business is structured. Is it appropriate for what you're doing?
Speaking of structure, I talked about our farm being in a bit of transition as we look to different generations. Certainly as baby boomers retire, if there is such a thing for farmers, there is going to be a younger generation looking to step into some of these operations. How can your lender be helpful through that process, whether it's young farmer loans, whether it is someone who maybe doesn't have the background finances that Dad did but are looking to become part of the business?
Well, it's certainly tough for a young operator. It's such a capital-intensive business. That's a huge barrier to entry for a young operator. With that said, though, I think there are a lot of operations out there that are looking around for succession plans. So, I think that's a place that we can come into play. Is maybe hooking up older operators who don't have a succession plan in place with a younger operator that we're aware of. I know Farm Credit has a Young Beginning and Small Lender Program that features some lower equity requirements, maybe some longer amortization terms on loans. Rabo Bank has a Rising Star program as well, and I'm sure there's various other programs available through other banks. I know the USDA has some direct lending programs and guaranteed loan programs that can also be a source of financing with some looser terms that might benefit a younger operator as well.
Anything from either of you?
Yeah, one of our more successful programs has also been a program called Generation Next, and that's allowed us, and I know other banks and institutions, both to the right and left of me, have been involved in these types of programs in the past as well. And it's really all about educating that next generation to be able to be leaders, be able to be supervisors, and manage the numbers as well as the producing assets of the farm. So a lot of good focus. The biggest thing, of course, is starting early. And maybe if the older generation was able to invest in other things than the farm. They may not rely 100% on selling the farm as their retirement asset, and that's obviously offered some flexibility. Profits interest partnerships and LLCs is a good way to, for the younger generation without much equity to earn via sweat and earnings. And of course, that's been a real big plus. But we also have a Farm Start program for new farmers just starting out. It's a small working capital loan. We're not talking large dollars, but it's a way for folks to that currently aren't involved with a family operation but get started in farming. So there is, with all the people wanting to move out of the cities into urban or rural areas, this is one area that they can come and possibly get started.
The only thing I'll add is that the other thing that your banker can do is bring some of the other resources to that succession discussion, which may be legal counsel, accountants. It could even be a facilitator. Sometimes you need a neutral third party to help navigate the family or the non-family members of two different generations through that process. And it takes time. It takes time.
I saw a lot of head nodding to that question, that help would be appreciated. When it comes to expectation setting, what should a producer expect from their lender if they're not hearing from them on a regular basis? If they don't have that relationship, what should a producer expect from a quality lender?
Well, I think, Matt hit on it earlier. It's communication. That communication is two-way. The lender needs to be in communication with their clients, and likewise, whether it's good news or bad news, you got to keep that open communication going, and then laying out the expectations. We certainly expect, as Matt and Roger have said, timely and quality financial information, and we would expect to be timely, getting back to clients with regard to what their requests are and the analysis of their business.
I think it's really key that the relationship is strong and there's a lot of constant communication that we've been talking about. So nothing really new or different in that area. I would just tell you that it's been a constant piece. There's always new entrants into the lending space, and sometimes they understand agriculture and sometimes they don't. And by having a lender like either one of us up here, that they understand the cycles that agriculture goes through. The last thing, you might be able to save 20 basis points by getting a cheaper rate through another lender, but are they going to be there when the cycle goes down? Or are they going to cut and run? And it's always something to take in mind and work and have a good interview with prospective lenders before you get really started with them.
I'm so relationship driven, and Rabobank, in our relationship with our clients, is so relationship emphasized that I can't imagine not communicating with my clients on a continual basis. I've got guys I talk to 3 or 4 times a week, maybe multiple times a day. So, but with all that said, I think it also depends on the client. Not everybody's the same. Not everybody wants the same level of interaction. So I think one thing that a good lender does is he gauges how often somebody wants that communication. But by and large, I go back to communication is key with your lender, and it probably needs to be regular.
When you think about your top producers, some of your best, most successful clients, are there things that they have in common?
They tend to be very detail-oriented in terms of profits, losses, and cost of production. I would say that's the most common factor I see is people that know the cost of production, can then target price levels for their commodities, whether it be dairy, corn, whatever, tend to rank high. That's a key component.
Anything to add from either of you?
I'll add real quick, in the beginning when I first started my career, a lot of my dairy farmer customers were obviously really good with cows, not so good with people. the top producers today are really good with people. And they also have that zest for learning. They're constantly seeking out different ways to bring new ideas to their farm, and that could be through some of the help they hire and or some of the advisors they have on their farm on a regular basis.
I'd summarize it this way: they plan, execute, and monitor. So they put a plan together for the business, then they follow through on that plan, and the most important part is monitoring it, because plans never work out. I mean, what did Mike Tyson say? Your plan goes out the window the first minute you get hit in the mouth, right? So I see them, our top producers, monitoring a couple of different dashboards. First off, it's a production dashboard. They've got a couple of metrics that they're looking back at, either on a daily basis, a weekly, monthly, annual basis. They've got a financial dashboard, same thing. And now the really top producers are looking at a macro dashboard. What happens if China quits buying dairy products, right? What happens if there's a livestock disease somewhere? What happens if interest rates go up, or the Fed raises rates? And those kinds of dashboards can give you an idea of what do I need to do to adjust my plan and execute in a different way.
I think we should open it up to questions in a moment, but I want to give the three of you a chance to leave us with any last thoughts when it comes to evaluating farm loans that we maybe didn't have a chance to touch on today that you think are critical for our producers to hear.
Yeah, I'll start. I think that, and I'd be curious from Roger and Matt, but I've evaluated farm loans the same way my entire career. You look at the strength of the balance sheet, at the cash flow, at the profitability, at working capital, and at collateral. The difference is the quality of those metrics changes from year to year. So the way we analyze loans hasn't changed, but what we do, depending upon where you fall in those critical financial metrics, can change how that loan looks and how you're going to analyze it from year to year.
Great point. I would say going forward, we're relying a lot more on all sorts of data to evaluate. It used to be, what was your debt per cow? Well, that's maybe one small factor out there, but it's really not that important. It all depends on how that fits with the overall investment in your farm. Are you using robotics? Do you have a special milk market premium that you were able to access, whether it's A2 milk or non-GMO or your organic, or on and on and on, all the different pieces. So being able to understand all the different data points and have a zest for it, I think Sam hit it on the head with having a dashboard that you can share and discuss with your management team on a daily, weekly basis is critical. And then obviously keeping your lender in the loop.
I don't have a lot to add other than just have a forward-thinking mindset. It's so competitive in our landscape today. Things have changed so fast because of technology, trade, et cetera, et cetera. I think you have to constantly be looking out ahead, trying to figure out what's coming next. You know, where are we going from here?
Wonderful. Well, we will open it up to questions. I'm actually going to pop my microphone off and come around with it so that we can hear your questions as they're coming, because they are recording the session as well, so I want to be able to hear that in playback. So who has a question?
And this might be an extension of where Sam made his final comment. Scenario where you have a farmer coming for a capital investment loan, large capital investment loan. Under this couple scenarios, one is a base access plan, and the other is a farmer who's in an area where the likelihood of that farm surviving to the next generation, affecting resale value and demand, might be diminished. Has that affected how you value certain assets, such as facilities or cows or machinery or whatever it is? And does it affect, when you change the value of those assets, do they affect the creditworthiness of a producer?
I think certainly when, value changes are gonna, those are gonna come into balance sheet metrics that we measure, things like that. Certainly that's gonna have an impact.
Are there any certain assets that, are there certain assets that the values change more dramatically than others?
I think we see, just probably dialing into the assets that we look at for operating or working capital loans. Your feed tends to go up and down. We try to hold the values at Rabobank at a pretty static level. We tend to tie those to production and repro and things like that. But we try not to move those around too much. Certainly cow values come and go. But I think the feed components tend to be the most dramatic movers in the price spectrum.
The only other addition I'd make to that is certainly the cash flow that asset is, and that purchase, that investment is going to be critical. Yeah, there is an impact on balance sheets, lost capital, whether it's a new asset or an existing farm that might be on its last generation. But having a plan and looking at the cash flow, one of the things we really try and pay real close attention to is the liquidity, the near cash. So your liquid assets such as your savings and accounts receivable, less your accounts payable and short-term debt, that really does a great job in making sure you have the flexibility to survive some of those cycles.
So Dave, you started that question with a large capital investment, and typically that means facilities and then livestock to fill them. And all of us are going to get an appraisal, so you're going to send an appraiser out there to evaluate that. They will do a market analysis to tell you whether or not that asset has the value or doesn't have the value, and then between the client and the financial institution, you'll have to make a decision on that. As an example, you go back 3 years ago, 200 to 600 cow dairies, their facility values decreased pretty substantially because nobody was buying them. If they were smaller than that, they may have had an alternative investment, or if it was larger than that, somebody may be able to expand it on down the road. With a base or a quota program, I think that's going to have an impact on how appraisers are going to take a look at what those values are, because can you expand that facility on down the road? I will tell you, at least I know Roger and I have talked about this, I assume Matt's going to be in the same boat, but if we've got a client that wants to expand their dairy, we're going to need some assurance from their buyer that they've got a home for that milk, that there is a market for it, because you don't want to put somebody into an investment and they're getting paid on the excess over that quota plan, which could be pretty detrimental.
Other questions?
Are there any rules of thumbs that you guys look at as far as, I know we mentioned debt per cow, but as far as capital debt per income or anything like that?
I've always had a real challenge with that, because not every business is structured the same way. When we're talking dairy farms, everybody has a dairy farm and a milking herd. But what kind of land base goes with that? Are they cropping their own land? Do they own the machinery and equipment? Do they own the manure handling equipment? And so every business looks a little bit different. I tend to look at it on what the trend is for that business itself. There are some general metrics. Roger mentioned one on debt per cow. You can look at debt per hundredweight. And there are really other financial metrics, operating expenses as a percentage of revenue, for instance, that you can compare from operation to operation. But it really depends on the structure of that business as to how it's going to perform, and that's why the trend for that particular farm over time I find to be much more valuable.
Couldn't agree more in having it trend by yourself, and of course with other farms in the region can help. We look at debt to EBITDA as a good way to discuss where that particular farm is from an earnings standpoint, and EBITDA is earnings before interest, depreciation, interest and taxes. And so it's really a great tool to use and look at how that goes over time. Another one we look at is the rule of thumb on debt service coverage ratio. So how well are you able to cover the debt payments on that farm over we use a blended 10-year term. And then we'll look at a 3-year trend of that debt service coverage ratio if all the debt was on 10 years. And what it does is it allows to even out those ups and downs, the 2014s and the other years since then that haven't been as strong. And if you put that together, I think you can get a better, more accurate view of what that farm's profitability can be over longer terms.
I think not to be redundant, I'll kind of go at it a little different way. We look a lot at the frequency of cash flow, for example. When we kind of establish what a comfortable debt level is, it seems to me that if your money turns over more quickly, i.e. dairy farmers are getting paid twice a month, a corn farmer is getting paid once a year. The operations that have more frequent turnover tend to support more debt. I think those commodity and price structures tend to adjust more quickly in those businesses. So I think a higher turnover business tends to support more debt. A slower turnover business tends to support less debt. And that's why, in crop farming, I typically see a debt load over 50% as starting to be troublesome. In dairies, I think they can sustain a little bit more than that. We do a lot of cattle feedlot financing down our way as well. Another business where things turn over, they're selling cattle every week. So those businesses tend to support a little more debt.
What is the number one reason why dairy farms are going out of business now? And when and why will that change?
I would say right at the moment it's supply. We have an oversupply of milk that's been created by a reduction in demand. With the economy, I think it's all tied to the macroeconomy.
There's so many factors. So the number one is certainly, as Matt talked about there, but there's many other ones that can enter. It could be health issues on the farm. It could be lack of next generation to take it over. Could be a really good farm that just doesn't have the liquidity to get through this down cycle that they may be going through. But what you will look at is the number of dairy farms in the U.S. over the last 70 years has gone down every year. So there's no stopping that trend. The beauty of our country is we're so darn efficient, and the group of you in the room that are dairy farmers are some of the best. And that's one reason why our world position in dairy markets is starting to really improve, is the efficiency of our dairy economy. So the number of farms will probably likely continue to decline, but the overall efficiency of the U.S. dairy industry is very bright. I think there's a lot of opportunities down the road, but it will be different, and it's competing with New Zealand and Europe and all the policies that can affect some of that as well.
I think the number one reason is that costs are higher than revenue. Costs have increased at a faster rate than revenue has, and that means margin compression. That's probably the number one reason that we see dairy farms exiting the business. A number of them because they didn't have another generation, and so that's why they decided to exit the business. But I think it's economics is the number one reason. But as Roger and Matt said, there's a whole host of reasons as to why.
What is the production level in Wisconsin, or let's say the United States is concerned? How has that fluctuated here in the last few years?
So in both cases, it's gone up. We're producing more milk. Milk per cow has increased. Cow numbers have certainly increased in the last 2 years. They've just in the last couple months started to come back down a little bit off of that, but the milk production has increased. And why is that? It's because of genetic improvement. It's because of feed quality. The livestock environment has certainly improved, and that's what's increased milk production in the U.S.
We have a couple on this side.
I'm wondering from each of you how you view robotics. 20 years ago, financing milking parlors, we would look at 20-year amortizations and write those loans for a longer period of time. But as things become more innovative, how are you structuring those loans?
So robotics, why have robotics come into play? And in a lot of reasons, it's been a labor issue that's driven the investment in robotics. And we've learned a lot in robotic milking systems in the last several years as more and more of them get built. So the amortizations aren't 20 years like they were when you built that milking parlor. It's much shorter than that. But you should look to see them get paid back in probably a 7 to 10 year time period.
Yeah, use of technology, and I would put robotics in that camp, has really allowed a lot of different business models to flourish, whether it's a tie stall facility going into a robotic situation or a $6 million 100 cow rotary. There's still a lot of efficiency that can be gained, but as Sam said, being able to pay for that in a shorter time frame is going to be needed just because of the rate of change is continuing to accelerate as well. And so that technology needs to be replaced with something better and newer, 10, 15 years at the most.
And I'll just try to boil that down a little bit. There's always a new widget, and I think that's the thing, whether it be, a lot of processing and handling businesses, there's always newer, faster, better equipment coming. And I think that's what drives maybe the shorter repayment period on structuring a loan for robotic would be just that, when's the next widget going to come, and what impact is that going to have on the value of the equipment that I'm financing.
For your top 10% of your producers, what's their profit per cow per year that is a goal that you shoot for? And a second question, with the production limits, what is something that you can do on the dairy that some of your top clients are doing to increase your net profit?
Kind of my rule of thumb is I think we're crazy if we start shooting for more than $1 to 100 weight profit margins. That seems to be kind of the typical range for me. I would love to see some $7, $8 100 weight like I saw in 2014 every year. I don't think that's reasonable, but I think $1 to each side of break even is kind of what I see as a typical range.
One of I talked to a couple of our dairy consultants before it came out, and they do a monthly dairy profit analyzer group of about 100 farms, and their goal on most of the top farms is to be over $1,000 profit per cow, and that's the top 10%. They're not there, and obviously it was easier in 2020 when you had very high profit coming from the federal government. But that isn't the case now, and that's been on a decline. They're more in the $850 range right now. But being able to compare your operation is more important than having a set number. The other part I would say is what's unique. You may decide that genomic testing on your farm is the best option because you've got jerseys and you can sell high-quality Jersey semen and or other replacements at a high cost right now, or a high profit right now. Maybe there's some other crops that you could raise rather than feeding them to the cows that is going to turn into some more profit. So there's just so many different options out there. But from a dairy farm standpoint, some of the others is trying to maximize the milk quality. You can't afford to give up 25 cents a hundred anymore. So you got to have ways to always maximize that quality and have a milk handler that lets you do that.
Yeah, I'll take on your second part of your question because I think, Roger and Matt hit on the first part, but what top producers are doing given current circumstances, that they're looking at that income statement and figuring out, as Roger said, how can I enhance revenue? How can I reduce expenses? And there are no magic bullets. You're looking for pennies. You're looking at a 0.5% change in an expense category. And that's how they're trying to glean a continued profitable future and be able to manage through the uncertainty that we're facing.
I did just hear one other one. We had several producers that got into the dairy beef. So they're, rather than raise 100% replacements for the herd, they're down in the 65, 75% range in breeding to beef. Surprisingly, the beef markets have held up on that. There was a lot of pushback originally that the size and the cut of that crossbreed was not desirable for all the processors. But they, so far, that's worked out for some, and that's an alternative that would be an example of people getting into something a little different.
So as a dairy educator, I have young people come to me every day. Can I farm? Can I do this? And I tell them yes. What would you say to these young people?
I would say definitely yes, and it's no different than us here or you folks in the room. You have a passion for what you do, and that's really what's going to make some difference. But the advice I give is to try and work closely with a mentor or two, people that you can respect, and don't be afraid to travel. You got to get outside of your comfort zone. It can't be just the farm next door or the home farm, and maybe it's out of the county, out of the state, or out of the country. I know a lot of the progressive dairy programs in college typically have an internship in New Zealand or some other country to try and help broaden their horizon. So I think those are two great ideas. And by the way, have fun at it. If you can't have fun in what you do every day, there's no sense going that route. So the big part I'd say is having fun with it.
I would say tell them, your path may be indirect. And I'll use a young producer that's recently relocated to our area from another state. Started out as a cow trader. He bought and sold replacements, things like that. He came from a dairy family, grew up on a dairy, but the family had been through some financial duress. His father had exited the business. He got his start as a cow buyer. That's what he did. He built his equity through that business, gradually worked his way into owning his own dairy, and expanded. So the path may take a little different direction than just walking onto a place and managing a milking herd.
Just to tag onto that, I mean, I tell young folks it's a marathon, not a sprint, right? It's going to take some time. You need experience. You need to build some equity. You need some help along the way. Name a business where you can get started in it with very little equity. You can't do that. So why would you expect to be able to do it in a dairy or any other kind of ag business? So, but it starts with experience, starts with building up some equity and some liquidity, and then figure out the path from there. But there's a big future for young people that want to get involved in this business. As somebody trying to hire somebody with an ag background to come in to loan money to farmers, they're like unicorns. You can't find them. So I think that's a big benefit. Just having that passion and desire to get into the business, you already got to step up on everybody else.
Yeah, we have standing applications if anybody's interested to work as a lender.
Stop, us too. Truck driver, you want to milk cows? I'll take applications too. All right, we appreciate your time so much. We thank Micro Technologies for sponsoring this segment, and to Sam, Matt, and Roger for sharing their decades of expertise with us and for your very thoughtful questions. We appreciate you spending this hour of Expo with us and continue to enjoy your time here.